Hey there, fellow investors. I wanted to make this quick video because there was some breaking news for Realty Income and Spirit Realty shareholders. On the 30th of October, before the market opened, Realty Income shook the investment world by announcing a significant move. They've agreed to acquire Spirit Realty, ticker symbol SRC, in a deal worth roughly $9.3 billion. According to their press release on their website, the two companies have entered into a definitive merger agreement by which Realty Income will acquire Spirit Realty in an all-stock transaction valued at an enterprise value of approximately $9.3 billion. The deal is expected to deliver over 2.5% accretion to Realty Income's annualized adjusted funds from operation AFFO per share. What's impressive is that they won't need to raise new external capital to finance this transaction. This merger will result in a combined enterprise value of around $63 billion, significantly enhancing Realty Income's size, scale, and diversification for future growth. They also said in their press release the following. Under the terms of the merger agreement, Spirit shareholders will receive 0.762 newly issued Realty Income common shares for each Spirit common share they own at the closing. This will result in Realty Income and Spirit shareholders owning approximately 87% and 13% of the combined company, respectively. The deal is subject to customary closing conditions, including the approval of Spirit shareholders, and is expected to close in the first quarter of 2024. The deal was not received well by shareholders as the stock significantly dropped after their announcement. Now, you might be wondering why Realty Income's stock price took a hit, falling over 7% after the deal was announced. The main reason behind this is how the deal is being financed. Realty Income will have to issue more shares of their own stock to pay for Spirit Realty. While this means they won't be accumulating more debt in our current high-interest rate environment, it also means shareholders of Realty Income will experience dilution. Realty Income is currently trading at $50.85 per share with a juicy starting dividend yield of 6.14%. Now, if you've been following O's journey over the past year, you might have noticed it's seen a 19% dip, and year-to-date it's down around 21.58%. In fact, it recently hit a 52-week low at $45 with a 52-week high at $68.85. So what should we as investors do with our Realty Income shares? To answer this question, I started to analyze the impact of this merger on the portfolio of Realty Income. On their website, Realty Income has presented a case for this acquisition. They currently have an enterprise value of approximately $54 billion and own a vast portfolio of over 13,000 commercial properties, generating $3.8 billion in rent annually. Their portfolio is well diversified, with 91% of their total rent being resilient to economic downturns and isolated from e-commerce pressures. Spirit Realty, on the other hand, owns 2,064 properties, primarily classified as defensive retail and industrial, with an impressive 99.8% occupancy rate and a weighted average lease term of 10.3 years. If you take a look at what Spirit owns, it looks quite similar to Realty Income's portfolio, including clients like Family Dollar, Lowe's, Circle K, and Dollar General. The deal offers several benefits, according to Realty Income. These include immediate AFFO accretion and cost synergies, an attractive capital stack, improved portfolio exposure and diversification, conservative underwriting, preservation of a strong balance sheet, and the enhancement of benefits of scale. Realty Income will become the fourth largest REIT and the 150th largest company in the S&P 500 by total enterprise value after the deal is completed. So, what should we make of this acquisition? While it might be painful in the short term for existing shareholders due to share dilution, Realty Income wouldn't be doing this if they didn't see a promising opportunity. With this acquisition, they are strengthening their position and are poised for growth. While REITs are currently facing challenges in the market, they will likely regain popularity as interest rates decrease. I'd recommend that anyone who's keen on dividends considers investing in Realty Income while their stock is still on sale. Keep in mind that I've always been in this stock for the long haul, and I believe it will be a primary source of income for my retirement. With that said, it's important to exercise due diligence and assess how this aligns with your investment goals. That's a wrap for today's video. If you found this information valuable, don't forget to hit the like button and subscribe for more high-yield investment strategies. Your support is always appreciated.